Well, hello to all you wonderful VITA volunteers. My name's Jim Simpson, and on behalf of the Central Arizona VITA Network, the City of Phoenix, and Masters of Coin, we're going to bring to you a series of videos that we've created covering specialized topics for returning and a little bit more experienced volunteers. Um, there are 5 of these topics that we've actually been hosting live sessions down in Central Phoenix, but we've had requests from several of the volunteers that couldn't attend the live trainings if we would do a video presentation of them. So we're going to do that. The 5 topics that are being covered is today we'll cover energy credits. Uh, the next topic will be education credits. The third topic will be covering ITINs and what if you can't pay? What if the taxpayer can't pay? What are the resources available to them? Then we'll do Arizona specifics such as the property tax credit or the retirement credits that you get, or military uh, subtractions, I should say, rather than credits, the exemption for ancestors, capital gains, sales taxes, those types of Arizona specific things. Then the final one will deal with pensions and how do you do that calculation when the taxable amount's not determined and stuff, and what are some of the tools that you can use and that. So with that said, let's get started now on this first session. This will be a little bit different on the first session because we're going to spend a little bit of time covering what's new in general. And then we're going to dive into energy credits. The remaining sessions will be shorter and they'll be more specific to the topic and won't include this overview of what's new and what are some of the reminders that we should be aware of. So with that all said, let's get started here. I will share my screen. And we will get started with what we're going to. This is the refresher things that are what's new, what are some of the reminders we need to think about. And so what we're going to cover in this first half of today's session is look at things that are out of scope, just a reminder of things. Now, this is new, the revised intake form. We're going to talk a little bit about that. Now, we've got it. There's some new things about energy efficient home improvement credits. That's going to be our topic that we're going to dive into in depth today, but I'll just kind of introduce it here. We'll talk about some of the rejects that we had last year and what we might be able to do to deal with those a little bit better this year. We'll talk about the importance of using notes in TaxSlayer. We'll talk about a little bit what's new about 1099-Rs and using that simplified method for calculating the taxable portion of an annuity or retirement. All of you will still have questions about 1099-Ks, and it's still an ongoing drama with what's going, so we'll kind of update you with what's going on that. And a couple of new items from the Secure Act. So first, let's talk about what's out of scope. And there's really nothing new that's out of scope, but just a reminder, Bitcoin and cryptocurrency. Now, that's only if they trade it or sell it. If they're just buying it and don't have that, we don't really care about that. But the question on the intake form sometimes, might mislead somebody to thinking that, oh yeah, I invested in crypto. Oh, you can't do my tax return. Well, yes, we can. It's only if you sell it or trade it or exchange it that we can't. Of course, our income's been raised to 67,000 from 64,000 last year. We can never do married filing separate. In general, returns for other states, it depends on the site, it depends on the site coordinator and the level of experience of volunteers, depending on where you are. But even in most sites, there are a few states that we just won't do. California, New York, some of those are really difficult to understand all the complexities. Here, even in Arizona, we've got a few complexities that if somebody in New Mexico is trying to do an Arizona return, they might forget about that uh, state retirement system exemption or the ancestors exemption or things like that. We can do small business returns, Schedule Cs, but not if they have a loss. And we can't do it if their expenses exceed 35,000. Even if they don't have a loss, if they've got more than 35,000 of expenses, we've got to refer them to a paid preparer. And then last is non-cash donations of more than 500. Now, I say last, this is just a small partial list. Look at your 4012. Your 4012 has got multiple pages organized by form about what's out of scope. So that should be your go-to. This is just to kind of remind you of the things that we see in common a lot here. Let's talk about the intake form because this is new. They've redesigned this, and the reason that they redesigned it, the goal of this is to increase the interaction with the client, with the taxpayer. Um, the form, I don't have a picture of it here, but just for you to visualize it, on the left-hand side is what the client's going to fill out. Oh, did you have any W-2s? Yes or no. Did you have any interest? Yes or no. The common things that we're used to. But what's different about this now is we have another whole right side, a gray area that the preparer has to ask, has to engage this taxpayer. Even if they answered no to it, we need to reconfirm that it's no. And what's even more important is we've got to write something on the right-hand side, either put a check mark or write no or not applicable, just to demonstrate that we have engaged the taxpayer with these. When we get reviewed by IRS representatives that come and review our sites, they'll look at these sheets and see, have we notated that we've talked to the taxpayer about this? So that's important. Briefly, I'll talk about energy credits, but this is where we're going to dive into in the last half of this session. So what's changed in this? Okay, so they changed the names. One can argue whether it's an improvement or not, but the names of these credits have always been somewhat confusing, at least for me anyway. They still are, but what we're going to do in the second half of this is kind of try to make it a little bit easier for you to tease out which credit belongs to which name, if you will. This one right here is called the Energy Efficient Home Improvement Tax Credit. It's 30% of the cost up to an annual limit of $1,200. This is one of the things that's changed. Some of you who've maybe done these, maybe somebody put on some new windows or put in a water heater or whatever, and you're looking at that and it says, oh, there's a $500 lifetime limit. Oh, taxpayer, have you taken this credit before? Well, I don't know. Are you supposed to go back and look at 10 years of tax returns? Just it hasn't been that long, but you know what I'm trying to say. Now they've just made it an annual limit with a thing. This provision expires December 31st, 2032. It has to be made to your existing home that is your principal residence. It can't be your second home that you've done. Maybe you got a cabin up in the woods or something like that. New construction doesn't apply. So, you have a home built and maybe there's options on there to put on a specialized windows or something that are energy efficient. No, that doesn't count. It has to be to an existing structure. And of course, these are all non-refundable tax credits. Here's just a brief thing. I'm not going to read all of this because this is what we're going to dive into today. But what you're going to find here, I'll just summarize, is that most of these things they're going to give you a credit for like 30% of the cost up to certain limits for each topic. And then there's like heat pumps, you get even a higher amount that you can do. But in total, yeah, here you can put air conditioners in, but in total, there's a total $3,200 limit per year. But then next year, you can do it again, okay? Here is Another part, now here, if I go back, I'm going to go back one screen. This is called the Energy Efficient Home Improvement Credit. So they changed the name of it from what you remembered from last year. Then there's another one called the Residential Clean Energy Tax Credit. These are out of scope. Now, I could read you this list. I won't read it. Most of what we see here are solar panels. Not many people are putting geothermal heat pumps, drilling holes down in the ground to tap into that, or putting windmills in their backyard. Most of what we'll see are solar panels. And we'll talk a little bit later today, even a lot of the people who put on solar panels, they wouldn't qualify anyway because they're leasing them. They didn't buy them. And even so, all of this is out of scope for us. We cannot do any of these. Here's another new provision in here. When calculating the credit, you need to subtract subsidies, rebates, or other financial incentives. For example, I bought a plug-in hybrid last year, and I put in a charging station in my garage, right? So I could have 240 volts for it. SRP gave me a $250 rebate. I had to subtract that from the price of the installation of the charger before I took a credit on it. Okay. Here's the clean vehicle tax credit. And this has changed quite a lot. It's for new EVs placed in service after April of 23 can get up to a $7,500 credit. It depends on a lot of things. Used ones could get up to $4,000 credit. Again, we're going to talk a lot more in detail about this in the second half of this session. Okay. And I won't go into a lot of detail here, but whether you get a $7,500 credit or a $3,750 credit depends on where the materials for the batteries were sourced, where the final assembly took place, all of those things. That it depends on the manufacturer's suggested retail price of the vehicle. But the good news is that there's a website you can go to. You can plug in the vehicle. You can see exactly what those limits are. And even better news is the dealer's supposed to give you a document right up front. So this is this slide. This is new as of 2024. The buyers are advised to obtain a copy, and it says buyers are advised. Actually, the sellers are required to give you this. That will tell you exactly what the credits are, how it qualifies, and all of that. I don't have a slide for this, but even more important right here is as of January of 2024, you can actually apply the credit at the time of purchase. And I would tell you to tell all of your, if say you have a client come in and they say, hey, I've heard about this credit. I'm thinking about purchasing one of these in 2025. You should advise them to apply the credit at the dealer's point of sale for two reasons, and we'll go into those reasons a little bit later. But it may help you avoid some of the income limits that you might have, or the fact that it's non-refundable. If you apply it at the dealer thing, you might avoid losing out some of that credit because of the refundability. Again, stay tuned for more on that. Okay, rejects. What were the main rejects that you had at your sites in last tax season? And I bet most of you are thinking to yourself, yeah, IP pins and Affordable Care Act, 1095As. And what do we do about it? For one thing, the intake and interview form last year would say, were you a victim of identity theft, right? And most people, they don't think much about that. I mean, maybe they were, maybe they weren't. But really what happens is, and this is one of those places where you really need to engage the taxpayer into a conversation. Because IP pins, sometimes IRS will just issue them. Maybe somebody tried to file a return with your social security number and they recognize that there's been some identity theft because you already filed the return and they sent you the refund. So they'll put you on the list of IP pins. They'll send you a letter saying, here, you need this IP pin to file your return next year. And if IRS assigns that, they will send these letters for 5 years. It keeps going on, and the IP pin numbers change. They need to keep those letters. But what happens? We've heard of all of these scams and frauds and things, and somebody opens up a letter. They have no idea that somebody tried to file a return using their social security number. They look at this letter and they think, oh, somebody's trying to scam me, and boom, it goes in the trash. So they come in here, they have no idea, they say no to that, but you need to query them a little bit and see, talk about that letter. The second thing that happens is a couple of years ago, IRS allowed people to sign up for an IP pin. And the first year you sign up for it, you get a letter. The second year you don't. Because when you sign up for it, you have to go on and establish an irs.gov account. And so they assume you're just going to go log on to your account and get your IP pin the second year. So some people forget about that. So, you need to engage them in the interview just to avoid getting these rejects, or try to reduce the number of rejects. We're still going to get some of them. This is ongoing. Now, what about the Affordable Care Act? Well, there again, the intake and interview form, it said, hey, did you have insurance under the Affordable Care Act? Well, who knows what that is? I mean, if you engage them in a conversation, you say, hey, did you get insurance through Obamacare or the marketplace? Now, the language on the intake form has changed a little bit this year. They reference a couple of things, the marketplace and that. But again, you need to engage them, because sometimes that, when you get them thinking about it, they say, oh yeah, I had 3 months before I got hired onto this new job that I did have insurance through that. Or sometimes they don't even realize that that's what they have. They're dealing with an insurance agent that signed them up for it. They don't even really realize where they got the insurance from. Or here's a third thing that happens. I've read that there's unscrupulous um, insurance agents who will sign people up just to get the commission off of something, and the person never even, they're getting enough credit to offset the premium. The person never even realizes they had insurance until their return rejects and it says, well, where's your 1095-A? So if we can engage them at the beginning of the preparation process to find out, how did you have your insurance? Did you work all year? Were you covered all year? Did you just go some without? Perhaps so. Try to get them thinking about it. Because if they did have it, we should send them away and tell them to call their insurance company and get a copy of that 1095-A so that we don't get rejects for them. Okay, the importance of notes in TaxSlayer on a return. This is really important that you put notes into it. Sometimes, you'll be working on a return, you get halfway through it, oh, they're missing some information, they've got to go away. You don't put a note into it, it just hangs out there in TaxSlayer and says in progress. And then so your site coordinator or the electronic return originator, well, they're not filing the return, but well, maybe it was done and you just didn't do the right button or something, right? Put a note if something's wrong. Other places where that's important is, maybe here in Arizona, we have a property tax credit and we need the parcel number, and we can go find the parcel number, but that takes another 5 or 10 minutes. It'd be a whole lot easier if we just had it in the notes right then and we know where we can get it. Or maybe there's a taxable amount of the 1099-R. We go through this whole process, the simplified method, to calculate what's the non-taxable portion of their annuity. Well, it'd be nice if we just put a note in there so that the next year we'll know how it was determined. And more importantly, if the return rejects, we need to know. The site coordinator or whoever's doing the electronic filing, they need to know before they reach out to the taxpayer what might be wrong in something. Another thought, well, here's how you can do it. You can go up through when you're in a return, so here we're in Tom Andrews' return, you can go click on this little down button and put a note as you're doing the return. It's best to do it as you go. When you get to the note, here's the little drop down thing. You get to the notes saying, I know most of you know this, but just to go over it, because I've got one more important thing to tell you. Under the note name, start it with tax year 2024. The reason for that is these notes carry over from year to year. And if you just put up here missing W-2 and that note carries over, well, maybe the site coordinator or whatever, before they go file it, they're going to say, oh, this is missing a W-2. Well, no, that was for 2023. Right? They're not missing anything. It's ready to be filed, right? So that's why we identify it here with the tax year. And then we can type in the text of the note here. Notes are extremely important. So, I tell my preparers, put a note with every return, who prepared it, who reviewed it. At least you get in the habit of using the notes feature then. Okay, taxable amount not determined. They've made an improvement to this section, so we'll quickly just go through this. As most of you know, if you get a 1099-R and the check mark in the box labeled taxable amount not determined, that means a portion might be taxable. You don't really know. You're going to have to query the client, maybe look at the last year's tax returns, but you maybe look down in the 1099-R, and is there something in box 9B? That one says employee contributions. If there is, that probably means that employee made after-tax contributions, and some of it may not be taxable. Maybe the preparer put a note in the software in the tax layer. That would be nice if they did. So you need to ask them, what was the source of this income? But anyway, once you kind of determine that, you get this little 1099-R that's got a box here. Now, beware, when you put it in the tax layer, it's going to automatically say that this whole distribution is taxable. But if this box is checked, and especially if down here there's something in here, you want to find out for sure with this taxpayer and try to see if we're going to have to do something here. So as I said a moment ago, when you put in this amount here, this populates, but then you get this warning. It says it's automatically carried. This can be corrected if necessary. And here's where you can get to the simplified method. Okay. If they have to follow the general rule, which is not likely, I'll show you why in a minute. Okay. 99% of the time, it's the simplified method. It's not that simple either, but nevertheless. Okay. So here was the simplified general rule worksheet, the data that you had to put in for here. This is what it used to look like last year, where it would ask us the age of the recipients at start date, and then it would say if it's a joint or survivor annuity, add the ages of the recipients, and we had to go calculate that. And in fact, when I would be teaching these classes and we'd be helping the volunteers get through that, they probably miss this more than anything, because what if they turn, the annuity starts in November, but their birthday was in May, or vice versa, their birthday was in December. That changes this age calculation. Many folks put in suggestions to TaxSlayer, hey, can't you calculate this for us? And they did. I'll show you that here in a second. So here's where you would get into the simplified method worksheet. This is the new one. This is the tax year 2024 now. So we click on that. It'll give you this notice, which you can read it once, but I will tell you here, I'll point out right here. Also, you must use the simplified method if your annuity start date was after November 18th, 1996. Now, that's like almost 30 years ago. And usually annuities don't start until you retire. So you're not going to find many people who would be using the general rule. They're almost all going to use the simplified method, right? So we get to the simplified method. We put in the gross distribution. with plan costed annuity start date. Now, that we're going to have to ask them, look at past year's tax returns, look at that box 9B on the 1099-R. That might be what that plan cost is. Then the date, these things have not changed, right? But what's changed is down here is that the software will automatically calculate it. And if you check this box here, it says, are the annuity benefits based on the life of the annuitant and the beneficiary? Then you've got the age of, the spouse in there, their age, and it's going to calculate both their ages. So that's different. These things are pretty much the same. You're going to have to put in the number of months paid in 2024. That will almost always be 12 unless it's the first year of the annuity or the last year of the annuity. It then gives you a summary page right here, just like 1099 divs and others that or interest would give you. So it tells you here, yeah, the distribution was 20,000, but this is the amount that's taxable. And then you can click on continue and it populates it for you right here. And if you need to make changes, if that doesn't look right or something, you can go in and make the changes. Here's another tool that you can use, and they both arrive at the same thing. I'm going to show you one advantage of using this tool, and this comes from Colorado Tax Aid. You can Google this. The guy named Jeff Bogart developed this. You could type in Bogart Tax Tools, Colorado Tax Aid, something, but it's really easy to find this, and it has this calculator here, annuity pension exclusion calculator. It pretty much asks you the same thing as TaxSlayer does. It asks you when the annuity started, what's the annuitant's birth date, was it a joint or survivor annuity, all the same things, okay? And it comes up with a calculation, and it tells you here exactly what we've got to put in the taxable amount. What's good about this tool is you can go print the table right here. And that table looks like this. It says, okay, in the first year, you haven't recovered anything in the prior years, but here's the exclusion this year. And then for the next 23 or whatever, you're going to get 581. Usually, I think it ends at 25 years. Yeah, right. So right after in 2046 right here, all that's going to be left is $378 that they can recover. But we can print this table out, put it in their envelope, and ask them to bring that back next year. And then we don't really have to do anything. We know what the exclusion amount is when it comes to next year. So that's the handy thing about this. Okay, 1099Ks. Everybody's got questions about this, and it's been confusing for the last couple of years. They're starting to kind of resolve this a little bit. So what's going on this year is you may get a 1099K, and these 1099Ks are issued by third-party networks. That can be eBay, Craigslist. I'm not sure, Craigslist probably just puts you with that, but eBay would be one, Zelle, Venmo, DoorDash, Uber, Lyft, right? And what this all started from, just to refresh your memory, is the Inflation Reduction Act in 2021 said, hey, look, all of you third-party payment processors that do this, you're going to have to, if somebody's, if you pay somebody or facilitate more than $600 of transactions, you've got to send them a 1099K. Wow. And everybody went up in arms. I send my kid $1,000 every semester, by Zelle, to go to school in Flagstaff, right? Now they're going to send me a 1099K and be looking for a Schedule C or something. We go out to lunch, the girls go out to lunch every Saturday, and they use Venmo, to transfer money back and forth. So you see how complicated this gets. So the first year they said, oh, never mind, we're not going to enforce this at all. And then this year, or last year, then they said, well, look, we're going to make it be what the old rules were, 22,000 or 200 and some odd transactions, right? But they said, we're still going to make this work. We're going to phase this in. And so now this year, um, I got a little ahead of myself. So let me go back a little bit before I do it. Um, First of all, these payments, they fall into three categories. One is business income. You know, Lyft and Uber, those things, if they're getting a 1099K, hey, they've been driving for them, DoorDash, whatever. We've got to report this on a Schedule C. But sometimes they're personal and non-taxable transactions. Okay. Um, there are certain things that are out of scope. If they're selling property that was used in the taxpayer's business, or payments received from hobbies or other not-for-profit activities, rental income. You know, we don't do rentals unless you're, you know, military affiliated. But so some of those things are out of scope. So all of these, the Inflation Reduction Act says that they have to issue them for $600 or more. But in 2022, they put that threshold to 20,000. Now, what have they done this year? For tax year 24, they're scaling it down. They're trying to get to that goal of 600. And this year it's 5,000 that they're going to issue that. But let me warn you, and in fact, many of you have already seen this. Some of the vendors or these third-party transactions, they coded their systems back in 2021, knowing that it was going to 600, and they've already got it in place. So you may see these Lyft things with 900 or 1200 or something. They didn't even have to send them one, but they send them one anyway. And we have to deal with it. We have to report it. I'll get to a minute about you know, what's reportable and what not. Just because they got a 1099K, if they don't get a 1099K, it doesn't mean we don't have to report it. They're still responsible for reporting all their income. But what happens in that case when they get a 1099K, and those transactions just involve personal gifts or charitable contributions or whatever. So I'm going to show you a way that we can exclude those amounts if they were reported in error. So usually things about 1099Ks that you need to know is the Pub 4012 will limit the types of 1099Ks that we can deal with. Let me give you a couple examples. Somebody's selling inventory. You know, they're collecting stuff and selling. I have a friend of mine, his son, 16 years old, and he goes and he scours these Goodwill bins, right? And he finds things that are popular among the teenage set. And he's making a ton of money doing this stuff, right? You know, the point is that he has to report this income on a Schedule C. It basically means it's self-employment. But now we're going to see these 1099Ks just for transfers of money that are non-taxable. You know, gifts, paying for things at restaurants or sending money to the kids or whatever, right? So here were those examples that I just said. Maybe grandpa sends you a cash gift for Christmas. So if the taxpayer receives a 1099K with incorrect information, in other words, it's got personal, I would say personal income, not expenses, right? Here's the first thing they can do is they can try to resolve the issue by contacting the filer and say, hey, this was a mistake. And in fact, what these vendors are trying to do now is classify the accounts into business and personal ones so that then they only have to send the 1099Ks to business ones. That's what IRS wants them to do. Okay. But second, if the filer isn't going to resolve it, and you know, let's face it, chances are they're probably not going to, right? Then the next, if you can't get that, we can offset the incorrectly reported amounts on the tax return. If I pulled up a copy of Schedule 1 that says additional income and adjustments to income, right at the very top, there's a line that says, what are payments that were incorrectly reported on a 1099-K? Now, what that means is you need to report the income so it matches the computers, and then you can back it out for that. Okay. And I have not seen in TaxSlayer where they've got the place to do that, but I'll show you where it's likely to happen. Okay. So step one would be we enter the 1099-K information that's reported. If it's personal and they tell us it's all personal, we just go into other income, put it in under other income, not subject to self-employment tax, put a descriptor, right? 1099-K income reported in error, right? So then we've got it in the tax return as income. Then we can go here, and as I believe that they'll put in here's where we can do it if they don't put in, but we've got deductions, then you go into adjustments, then you go into other adjustments, adjustments not listed above. I think the final version of TaxSlayer will have a box right here that says 1099-K reported in error so that it can populate the box onto Schedule 1. And then we want to type in a description about the 1099-K received in error. That's in case they don't have that box set up. I think they'll have the box set up and we won't have to type in a description for that. Now, here's something that you may not know is you can attach a note. Now, I'm not talking about the note that goes with the software, but you go into miscellaneous forms, and then there's explanations, and then preparer notes. The difference with this note is it transmits with the tax return. Now, whether IRS will read those or not, and my suspicion is that the computers are going to look at something if they see 1099-K income or whatever, and they don't see, I'm not sure how they'll program them, but they could get a letter, and the computers are going to send a letter, and at least until they get AI more advanced, they're not going to be reading these preparer notes. But if it ever gets to an auditor, then an auditor probably will see this note and may just decide to close the case and move on. So it wouldn't hurt to put that in there. Okay. What are new provisions of the Secure Act 2.0? It's just a couple of things here to go over. One, the age for starting to take required minimum distributions is now 73. Just as a refresher, once you have money sitting in an IRA or a 401k that's been sitting there tax deferred, IRS doesn't want you to let it sit there forever. They want to get their share. And so it used to be you had to start taking distributions at 70 and a half. The Secure Act kind of started bumping that up. So now we're up to 73. It's really important if you see somebody that's not taking, that's this age and not taking distributions, if they leave money in there, there's a 25% penalty, and that 25% penalty continues on until they get it out of there, right? So then the other thing about Secure 2.0 that this is new, pay attention to this one here. As you know, most premature distributions made before age 59 and a half, they have to not only pay tax on it, they got to pay a 10% penalty on top of that, unless they have an exception to that penalty, right? Here's a couple of new exceptions. You can now cash out as much as $1,000 from a traditional 401k or IRA to cover an urgent need, and you get to define what counts as an emergency. Now, going to that, Beyonce concert that you've been waiting for all your life doesn't constitute an emergency, but I'm being a little facetious here, but you get the idea. They really haven't given much guidance. It's just going to be judgment. And I don't think they're really going to look real hard at this, because for one thing, there's a limit. You can only take out $1,000 once every 3 years unless you pay it back. And of course, and if you see any of our clients, taking this distribution, first you see a premature distribution, we should always ask them, why did you need to take out this money? Why didn't you leave it in there for retirement? And usually the common things they might tell us is, well, it was just for an emergency, or they say maybe higher education expenses. So then we know it's not subject to a 10% penalty. Or maybe they say, I was going to buy a house and I was told I could take some of this money out to buy a house. And yeah, they could. But now they can take out $1,000, but you should tell them they can pay it back once you get it, put it back in there, which would be the best financial planning advice for them. Not only that, then if they hit another emergency next year, they could take it out again. In other words, not wait that whole 3 years. If they pay it back, then they could take it out again the next year if they needed to. Plus, that's for retirement. If it's an emergency, great, but get that back into the retirement plan. Then there's a second one. And this one might be a little harder to tease out of somebody because it's hard to think about what the right question to ask would be. But if they were a survivor of domestic abuse, they can withdraw up to $10,000 or 50% of the available money that's in there. Okay, so again, you're just going to ask them, well, why did you need this money? And, if you have to use your counseling skills a little bit. And then somebody says, well, yeah, we got divorced and separated and had to go out and I had to get the money to be able to get my own apartment and stuff. And, then you might describe the exceptions to this 10% penalty. And maybe they'll say, yeah, I was a victim of abuse. Yeah. So then you might know what you could do. Here's the screen where you're going to be able to put this in. You would say early distributions that aren't subject to the 10% tax, and then you've got to select the reason for exemption. As of now, those 2 additional exemptions are not in Practice Lab, in TaxSlayer. So when you drop down the list, here's the list. These are the common ones we see right up here. I assume that TaxSlayer is going to put in those other 2 things on the list here before long. Okay, that's the summary of what's new. And I always want to thank the volunteers. We can't do this without you. We really sincerely appreciate your help. In this slide here, we've got some credits of where we got all of this stuff from here. And by the way, I need to thank my colleague, Gene Gieseking, he's a City of Phoenix volunteer, because he's put most of the work into these slide presentations too. And so now we're going to move on to our refresher topic. I'm going to stop this share. And then we'll move on to energy credits. So let me share this presentation with you. So this is going to be a refresher session on energy credits. And what we're going to talk about on here is just give you a brief refresher of credits versus deduction and refundable versus non-refundable credits. That's just to set the stage for what we're going to talk about. And then we'll talk about non-refundable credits, home improvement, solar, and electric vehicles. So these are the energy credits that we're going to talk about. I won't dwell a lot on this, but just as a reminder that a deduction lowers your taxable income, where a credit actually decreases the tax bill. So, credits are better than deductions. Then there are refundable credits versus non-refundable credits. So a refundable credit is subtracted from the taxes you owe after deductions, and it can reduce your tax liability to below zero. In other words, it can give you a refund, and thus that's what they call it, a refundable credit. On the other hand, a non-refundable credit will only bring your liability down to zero, and if there's any left over, you lose it. There's a few examples where you might be able to carry forward the credit, but they're very rare. Usually it's like you use it or lose it. So just in summary, a credit is better than a deduction, and a refundable credit is better than a non-refundable credit. So where do you access this in TaxSlayer? If you're over here on the left-hand side under the federal section, you go click on deductions. So now here's a deduction screen, and here's where you're going to get to credits. I'll tell you, here's where you can access all of these credits right here. So here is the credit screen. Many of these things are out of scope for us. I won't really discuss those. I think you're aware of those. But here's where we're going to access the residential energy credits. So just as this is a nice little table, I like to kind of separate the refundable versus the non-refundable. And there's a couple of credits that I like to call hybrid credits, where a portion of it is refundable and a portion is non-refundable. You know, over here, the earned income tax credit is one of the biggest ones we can, and there's an Arizona property tax credit. But as you can see from here, most of the credits are non-refundable credits. In other words, you've got to have a tax liability to be able to use those. There's one here, and here I'm going to start the disclaimer here. Okay. It says out of scope residential clean energy credit. Well, the names have always been somewhat confusing. They improved it a little bit, but I would still say it gets kind of confusing as to, well, what's the difference between energy efficient home credit, residential clean energy, and we're going to see there's a residential energy credit. You know, well, which is which, what goes into which, and that. I'm going to show you a couple of tricks of how you can find that out here in just a second. So this one is the energy efficient improvement credit. And in fact, before I start talking about these specific ones, let me kind of stop sharing this presentation and then share a browser. If I can find where my browser was here. Yeah, right here. So now I'm sharing a browser here. And my advice to all of you, you know, usually some of you will become experts at these energy credits. And usually at a site, we all kind of develop little specialties of expertise, right? I would tell you that, and you don't do many of these, you know, these, not a lot of our clients are able to take advantage of these things too much. So you don't do very many. And when you do them, you kind of need to hit the books a little bit. And I would tell you, open up a browser, type in Energy Credit 2024. It comes right up here to irs.gov. And right in here, this will kind of give you a good summary of some of these credits, who qualifies, what some of the definitions are. You know, what if this, I won't dwell on this too much. But what I want to really show you right now is to look at the form. This is the form 5695 residential energy credits. Now, because this form will tell you a lot as to which component goes where. And in a minute, we're going to tell you what things are out of scope. Right here, I'm going to tell you part one of this form, right here, say residential clean energy credit, that's out of scope. You may say, well, wait a minute, he just said we could do residential energy credits. Well, we can. I'm going to show you where that term comes in just a minute. But if you just look at this form, this part one is really talking about, well, okay, these are solar panels. It says solar electric property. Those are solar panels, right? Most of this other stuff you're never going to see. I mean, you're not likely to see from many of our clients that they've installed solar panels and paid for them, right? We deal with low income folks, right? Usually they're going to come in, if anything, they lease them, which then they don't qualify for the credit. But the rest of these credits are like for, you know, putting in windmills in your backyard or drilling a hole in the ground to hit geothermal stuff, right? I mean, you know, they're just not going to apply to us. But everything in part one is out of scope. Okay. If I scroll down here, here's part two. And this is where my lecture was going to start, with energy efficient home credit. And I won't read all of this to you, but you can kind of look down here. It'll tell you which things fall under. And notice this is section A, qualified energy efficiency improvements. Well, geez, aren't these all qualified energy efficiency improvements? You see where I get kind of confused in the nomenclature. But here you can say, oh, here's insulation, here's exterior doors, here's windows and skylights down here. Oh, but here now we have a section B called residential energy property expenditures. Wow. Thought I just saw that in part one that was out of scope. Well, no, that was clean energy property expenditures, I guess. So anyway, this is why I like to use the form to look under here, because I can see here now, okay, well, yeah, okay, here's where I'm going to do central air conditioners, or here's where I can do a natural gas water heater, right? I can see exactly what I get to do here. Oh, here's where I get to do the home energy audits, right? So at least this form really gives you a good indication of stuff. So let's go back and look at some of these things that are on this form. I'm gonna share my presentation again here. Okay, so what has really changed? So now this year, we're going to get 30% of the cost of a specific amount that can range from $50 to $600. Again, that form can kind of tell you, oh, hey, there's a maximum of 600 here, a maximum of 1200 here, maximum of 2000 here. There's different things. We'll kind of go over those different things. In general, there's limits to some of these things that cap out at 1200, and then there's other additional things like heat pumps is the most common one. There's been a big push to put in heat pumps. There you can get 2000 in addition to these other things right here for 1200. So the max credit you can get in a year is 3200. But then the following year you could get the same thing if you spent that much money on it, right? And most of this is 30% of the cost, maxing out at 3,200 bucks. So what are some of the things? You could get 30% of the cost of the insulation that you put in. You put on a new roof. This would be really common, that homeowners anyway, that do that. Windows, 30% cost, but see, now there's an annual limit of 600 to that, okay? Doors, an annual limit of 500, but that's an annual limit. It's not a lifetime limit like it used to be. So this is really good news for us. You can actually do an energy audit. Now, you want to be careful about some of these things, like when you read, and I'm going to show you the next trick in a minute to really tease out some of these things, because look at this. It says the labor cost for installation does not qualify for the credit. So all of these building envelope components, doors, windows, skylights, right? Installation doesn't count. I mean, roofs, I mean, a big portion of that would be installation, right? So you need to be aware of those little idiosyncrasies of it, because we're going to see some difference in a minute. So now we get down, and this is in that section B part of the form, right? Where you can put in a new air conditioner, but the most of a credit you're going to get is 600. You could put in a heat pump, and they'll give you 2000 towards the heat pump, or a gas. For probably most of us in Arizona wouldn't be using these, but we would have a gas water heater. That could be that. Look here, no lifetime limit for the credit. And as I said, the maximum total credit combined is 3,200. But I want to point out something. If you go look at that form 5695, it'll tell you that the installation cost for air conditioners does count. So now I'm going to show you a trick of where you can find some of these things, because you think, wow, this is too much. I mean, where do I get that? So let me change screens again here, and we'll go back into a browser here. And what if I go back here, and instead of just typing in energy credit 2024, I type in energy 2024 FAQs. Frequently asked questions about energy efficient home stuff. Okay, there's not many, it's just a few, but these can be very enlightening to, what you can do. For instance, let me tell you on these things here. May a taxpayer carry forward unused credits? On it tells you the rules vary by credit. Under the energy efficient home improvement credit, oh geez, which one was that? Okay. You go look at the form again. Okay. A taxpayer may not carry the credit forward. Okay. So that means so use it or lose it one. But under the residential clean energy property credit, okay, no, hold on. Oh, there's that word clean. So that was in part one. Oh, that's out of scope. But if for some reason somebody's asking if they put in solar panels and they can't use all of the credit this year, they can carry it forward to the future tax year. So again, these frequently asked questions are really good to help you determine some of this stuff. Okay, let me go back into sharing our presentation and show you some other things here. Okay, so here's the screen in TaxSlayer that you would go into. Again, some of the terms, which one do I do? Like this residential clean energy. I wish they would have put this up at top because that's the one that's out of scope. I don't know, maybe that's why they put it at the bottom. But nevertheless, pull out the form. If you're not sure where the air conditioner goes, pull out the form. You're not sure where the windows or doors go, pull out the form, or you can just open them up and you'll see what it is. So let's go on to the next screen here, right? It's going to ask you qualifying questions, right? This is another thing I didn't really say here, but the components are supposed to remain in use for at least 5 years or expected to, reasonably expected to. And they have to be, if they were related to the construction of this main home, if I click this box, it's not going to allow any of them, right? It can't be for construction. Okay, you put in the address of the home. Now, TaxSlayers use this little thing here to where you can use your main address. Some of the students that I've trained in here, the returning volunteers, I would say, they told me they got a lot of rejects because they didn't type in this address. So maybe TaxSlayer used this thing but whenever you see those red asterisks right there, you've got to put something in here. Okay. City, town, state. Okay. So here, now you know that under this credit, and I forgot which one we're under really, but here you can tell, okay, here's where it's talking about the doors and the windows and the insulation stuff. Okay. So that's going to be under part T2, section A, right? Again, go back to the form if you're not sure and look at there. So here is that part one on the form, which was solar electric property. It's out of scope. I mean, and we're probably the only thing we would ever see is solar panels, right? I would tell you, yeah, here's some more information about it, just maybe for your own benefit, that it's right now it's 30% of that, but it's going to drop down to where it kind of starts to phase out by 2035. So if you're thinking about putting in a biomass furnace or something, but I don't know. I guess this is saying in addition, it doesn't apply to biomass furnaces and water heaters anymore because those went under section B of the other credit. Before it was part of this credit. But I guess what I was saying, if you're going to put in solar panels, you may want to do it sooner than later. You'll get more of that. This is another little thing right here too. It says, however, it will also apply to battery storage technology with a capacity of at least 3 kilowatt hours. I don't think we're going to see many of our clients get that, but what this is kind of trying to encourage people to do is like those, in your garage, you put up a wall storage battery thing. I mean, this is new technology they're trying to encourage to where you could have solar panels that charge a huge battery in your home that'll power your home at night. And, so just that's for your own information. I've already talked about this, how purchase solar systems are the only thing that would qualify for that credit, even though it's out of scope. Again, this is for your information. Lease solar systems, the lessor the company who leases them to you, they're the one who gets to take the credit. Okay, let me take a breath here, get a drink, and let's move on to vehicles. Now, again, just to set the stage for this, we deal with low-income folks. Most of these folks aren't buying electric vehicles, especially not Teslas and those kinds of things. But the prices are coming down, and you're the last people I need to tell that there's been a big push towards this, and the push is working. They're selling a lot more electric vehicles these days. And the Inflation Reduction Act put in some extra credits. I mean, it expanded the credits for electric vehicles, and they modified some of them. So here's one of the modifications right here, is that there's two credits. It's either 7,500 or 3,750, or I guess zero. But the idea is that it has to have final assembly in North America to get this full 7,500 credit. In addition, it's got to have a percentage of the materials, the minerals that go in the battery, the minerals that go in the battery, and then the components of the battery be assembled in North America. Otherwise, if only one of the above criteria is met, you only get a $3,750 credit. I bought a plug-in hybrid last year, and yeah, it was assembled, I think, in North Carolina, but a lot of the components came from China or wherever, and I only got a $3,750 credit. And then also, here's another thing: the manufactured suggested retail price can't exceed $55,000 for sedans and $80,000 for a van, SUV, or pickup. And you're saying, oh my goodness, how am I going to know this stuff? I don't know what percentage of minerals. Well, here's the easy thing, is there's a website to go to. And in fact, we'll go look at that website, that you can easily tell what the credit is. And so let me just kind of show you, and it's just kind of for your curiosity, if nothing else. So if I were to go to, it's called fueleconomy.gov, right up there. Okay. When I go into here now, this site's got a lot of information here. You've got to kind of read real carefully down into all of this stuff here. New on fuel economy. Oh, here we go. New federal tax credits for clean vehicles. So when I click on that, and then this has got for both new plug-in and fuel cell electric vehicles. By the way, fuel cell would be a battery too, but pre-owned plug-ins, right? Older ones that are new, I think this will phase out here pretty quick. But let's go look at these new ones. You're thinking about shopping for one, right? So let's just, you want to know which ones are going to qualify for which credits, right? So let's say I'm going to take delivery before next Tuesday. Today is day after Christmas, just in case you're wondering. And okay, so I'm gonna look for 25, model year 25. I'll say show me everything, show me both electric and plug-ins, so I can see all the vehicles right here. I can see what the manufactured suggested retail price is, what the full credit is. Oh, look down here. Here's a Ford Escape plug-in hybrid, and that's only going to get $3,750. Wow, that must mean some of the components are probably manufactured someplace else. Here I happen to notice something else. Well, I don't know about you, but sometimes I look at these Teslas and I sometimes can't tell the difference between a Model 3 and a Model Y. Well, I think the Model Y, they're assuming is an SUV. And the manufactured suggested retail price could be $80,000 for that. So you can see how this website would be pretty handy to you. Let me stop this share and go back to our presentation. So this is kind of what I was showing you how I could do, but now there's some new things that have happened, okay? So here's a couple of very important things. No credit is allowed if the taxpayer's AGI exceeds 150,000 single to 25 head household. Now, granted, those aren't going to apply to our clients, but maybe they might apply to you. It might, no. But they might buy a used one. And here you can get even up to a $4,000 credit. Again, I could go back to that fueleconomy.gov site and figure out which does. And the adjusted gross income is much less for those, right? And as I said, here's where we just went to that fueleconomy.gov site so that you can go in there and you can search it. Now, here's something that's new, and I really want to emphasize a couple of things about this slide right here. So it says beginning 2024, the dealer where you buy the EV, the electric vehicle, they have to give you a note, a time of sale report specifying exactly what the credit is that you're going to get. And hopefully our clients are going to come in with that certification. We won't have to go look any of this up. But we all know what happens to that paperwork sometime, you know, and will they bring it in when they come to get their taxes done? Well, who knows? But here's something that's not on the slide, and this is very important, okay, is beginning January 1st, 2024, the purchaser can now apply the rebate at the time of sale, you know, reduce their down payment for it. Now, of course, the clients that come in here that bought one in 2024, well, there's nothing you could do. But if somebody is saying, hey, I'm thinking about doing this next year, or maybe you are, here's the advice you should give them. And I'll tell you why for a couple of reasons. One, tell them to apply the credit at the time of sale. Because, number one, we both know that this is a non-refundable credit, right? If you get to the end of the year, you've got a $7,500 credit and you only have $5,000 of tax liability, then you're going to lose $2,500 of the credit. If you apply it at the time of sale, you don't lose it. Second, it is subject to those income thresholds I told you about on the last slide. And the rule says that if your income exceeded that threshold in the prior year and the current year, you get to the end of the year, you've got to file a tax return, you're going to have to pay back the credit. But if it fails in either one of those 2 years, you know, you don't have to pay back the credit. So in other words, last year you were a little bit lower than that credit. You definitely want to apply it, because even if this year you go over, you won't have to pay back the credit. So the worst thing that happens is you get to use that $7,500 for the year, even if you did have to pay it back, right? Okay, so where do you find this in TaxSlayer? Now, if I put you to sleep in that last little bit, wake up here, because if you're going to do this, be careful, because look down here, this has got qualified electric vehicle credit. Oh yeah, okay, that's what I want. I want electric vehicle credit. Oh no, read this thing. It says, this is used to claim any unqualified electric vehicle passive activity credits. These are the things that flow through on K1s and stuff like that, business credits, right? It has nothing to do with us. We will never do anything that has anything to do with a passive activity. We want this one, clean vehicle credits, the ones that are on Form 8936. So that's the one we want to do. And then when we do this, see now here it's going to ask you to enter in things like your prior year modified adjusted gross income. This will help determine here, I'll show you the more questions here. So puts in your single, you put in prior year adjusted gross income. Much of this, you need to check this box because it has to be for 100% business use only, okay? I mean, don't check the box if you're using it for business use or you're getting credit from a K1 pass through. This is not where it comes from. But, you know, most of our clients would check this. But then when you hit continue, here's where you're going to put in the qualifying vehicle information. You know, you put in the year, make, model. Okay, you got to have the VIN number. Now that'll be on that form that they bring you. If they don't bring you the form, they're going to have to go out and get their registration or something else and do it. So then it asks you some questions. These are all required questions. Was it placed in service during the year? You know, I've had some people here, we're right in December of 24 now. Hey, you go purchase a vehicle. Yeah, I'm gonna have a big tax liability. Hey, maybe I can get my taxes down, get this $7,500 credit. But the dealer says, well, it won't be ready till January 10th. No, even though you signed the contract December 15th, whatever, you have to place it in service in the year. So you don't get the credit until next year. Okay. Then this question right here is, did you transfer the credit to the dealer at the time of sale? And if you selected yes, that's where all that prior year adjusted gross income comes in to calculate whether or not you have to pay back the credit. More often than not, especially with our clients, they don't have that high of adjusted gross income, but part of this is for your information as well. Transfer the credit. Did you resell the vehicle? You can't churn these credits, right? I mean, you can't just buy it to get the credit and then sell it, Okay, here it's going to ask you for the tentative credit amount. It will be on that form that the dealer gave the client, or you got it from fueleconomy.gov, whether it's $3,750 or $7,500 or $4,000 if it was used, right? So then you get the summary information for doing that. So that ends our session on energy credits. I hope you find this useful, and I hope you'll stay tuned for our next session where we're going to talk about education credits. So with that, I'll bid you good night.